It's a bit like looking at that weather app on your phone.
Right, the one that never quite gets it right.
Yeah, exactly. It confidently says it's sunny out, maybe 75 degrees. But then you look out your living room window and there's a literal tornado tearing up your street.
That is a very accurate description of the vibe right now.
Because that massive disconnect, between the comfortable data on your screen and the total chaos outside that is exactly what it feels like to look at the stock market today.
It really forces you to question your own sanity a bit, doesn't it?
Oh, 100%. Because here we are, right? It's May 2026. The S&P 500 is just casually hitting all-time highs.
Yeah.
Yet the daily headlines you are reading are dominated by geopolitical wars, lingering recession fears, and just some, frankly, bizarre corporate behavior.
You look at the broader landscape, and the pieces just, they don't seem to fit together at all.
Right.
But to understand the market today, you really have to look past those sensational headlines and just focus relentlessly on the underlying math.
And to do exactly that, we have a fantastic stack of sources to unpack today.
We really do.
We're pulling comprehensive macro analysis and some very specific first quarter earnings breakdowns from Steve Eisman's The Weekly Wrap.
Which is always a great read.
Oh, always. And we are combining that with some raw, real-time Friday dashboard data that tracks investor sentiment and market volatility.
So we're getting both the fundamentals and the feelings, basically.
Exactly. The mission here is to look under the hood of this May 2026 market and really figure out how it's shrugging off so much global friction. Like, is this rally built on a solid foundation, or is it just pure speculation?
Okay, well, it starts with looking at the actual corporate scorecards, right? We have the Q1 earnings data, and it's almost fully printed.
Right, most of the big players are out.
Yeah, over 300 of the 500 companies in the S&P have reported,
Yeah.
and the numbers are just staggering. Wall Street analysts have actually had to steadily revise their revenue estimates upward as the year progressed.
Okay, let's unpack this,
Yeah.
because that feels entirely backward to me.
How so?
Well, usually analysts start the year highly optimistic, and then they slowly downgrade their expectations as reality sets in.
Exactly, yeah. But the exact opposite is happening here. Back on January 1st, the consensus estimate for S&P revenue growth was about 7.5%.
Okay.
By April 1st, they had to bump it to 9%.
Wow.
And by May 4th, it hit 10.5%. And perhaps the most surprising data point here is that all 11 sectors of the S&P actually beat their January 1st revenue estimate.
Wait, all 11? Even the laggards?
All of them. And it isn't just a revenue story either. Operating margins, so the actual profitability of these businesses for the next 12 months, are currently sitting at an all-time high of 20%.
That's wild.
Just for context, that number was 16% back in 2023.
Okay, so the math you are describing points to this booming, incredibly healthy economy. But that brings us to the core paradox, this K-shaped economic reality everyone talks about.
The divert.
Yeah, because Zillow is explicitly stating that the housing market is effectively flat. And if you look at the lower end of the economy, the average consumer is heavily constrained.
They are definitely struggling.
So how on earth can the S&P post record revenues and 20% margins if everyday people are barely scraping by?
Well, what's fascinating here is the structural dominance of the index. It's just heavily skewed now. Infotech alone now makes up 35% of the S&P 500.
35%.
Yeah. And to put that in perspective, it was only 20% a decade ago, back in 2016.
That is a massive jump.
It is. And if you add in the tech-adjacent giants, companies like Amazon, Google, Metatech, is effectively 50% of the entire index.
Half the pie is just tech.
Exactly. And the infotech sector alone just posted a 28.7% revenue growth.
Okay, so it's less like a group project where one person does the work and more like a massive cargo ship.
I like that analogy.
Like the lower end of the economy is essentially a leak in the hull taking on water. But the tech sector is an engine so incredibly powerful that the ship is still setting speed records despite that leak.
That's a perfect way to visualize it, because it really is about the brutal mathematics of percentages.
Right.
As the lower part of the K-shaped economy shrinks in its overall spending, its percentage impact on the S&P 500 also shrinks.
Oh, I see.
Tech has become so overwhelmingly massive that it acts like this mathematical shield. As long as that 50% of the pie continues to report stellar, near 30% growth numbers, the index as a whole becomes practically immune to the struggles of the lower-end consumer.
Okay, that makes sense. That totally explains the mechanics of the high prices, but it makes me wonder about the psychological side of all
The
this.
sentiment side.
Yeah, because we have this real-time market dashboard data, and there is a massive disconnect between what investors are saying and what they're actually doing with their money.
You are looking at the sentiment versus speculation gap.
Yes. Because if you ask people how they feel about the market, they seem totally level-headed, right?
Right, the survey data is pretty calm.
Exactly. The AAII Investor Sentiment Survey, which, just asks individual investors if they're bullish or bearish, shows people are only modestly optimistic.
Just kind of lukewarm.
Yeah, you've got about 38% bullish, 33% bearish. That's a spread of just 5 points. Nobody is throwing a parade here.
And the bond market agrees.
Right. You look at the IC BOFA Move Index, which basically measures how volatile the U.S. Treasury market is. It's often viewed as the bond market's fear gauge.
It's sitting at 75 to 85, right?
Yep, which is completely subdued. No panic there at all.
So both of those metrics suggest a very rational, cautious market.
But then you look at the options market. The daily CBOE equity put-call ratio triggered a severe alert in the data. It dropped to roughly 0.46, which is well below its usual threshold.
And that's a huge red flag.
Yeah. It really is. And just to clarify for you listening at home, a call is basically a bet that the market goes up, and a put is insurance against it going down.
Right.
So a ratio under 0.5 means there is this massive explosion of speculative call buying and a huge drop in people buying insurance.
They're just rolling the dice.
Exactly. If people are telling surveys they are just modestly optimistic, why are they throwing away their insurance policies to buy lottery tickets?
It is a brilliant question, and it really highlights the power of FOMO, the fear of missing out.
FOMO is driving the bus.
Completely. Investors aren't necessarily euphoric about the state of the world. They see the geopolitical tensions. They know the housing market is flat.
Yeah.
But the tech rally is so relentless, and the math we just talked about is so undeniable, that FOMO is just forcing their hands.
They can't just sit there and watch it happen.
Exactly. They feel they cannot afford to sit on the sidelines while tech posts almost 29% growth. So they are piling into these speculative bets simply because the cost of missing the upside feels entirely too high.
But, treating tech as this one big invincible monolith is actually a huge mistake right now, isn't it?
Oh, absolutely.
Because looking at Eisman's sector breakdown, AI is creating a brutal internal divide within the tech space itself.
It really is. We are seeing a profound split between the companies building the physical infrastructure for AI and the companies writing software.
Right. The hardware companies are clearly selling the shovels in this gold rush.
And they are making a fortune doing it.
The data shows AMD posting a 38% jump in sales. Arista Networks, which builds network switches for AI data centers, saw their earnings per share jump 34%.
It's incredible growth.
Even industrial companies. The folks physically constructing these data centers, like Rockwell, posted a 9% organic sales growth. They are undeniable winners.
But then, when you cross over to the software side of tech, the narrative just completely flips. Our sources actually describe it as an AI panic.
And this is the part that genuinely broke my brain. Let's look at Palantir.
Oh, Palantir is the perfect example.
They report an incredible quarter. Earnings per share are up 154%. Commercial revenue is up 133%. Just absolute home runs.
Incredible numbers.
But their stock is down 22% this year, and Shopify is down 30%. Oh, wait. Palantir's revenue is up 133%, but the stock is down 22%.
Yep.
Are investors just assuming AI will make Palantir software obsolete before they can even cash in on these earnings?
That perfectly captures the dynamic, yeah. The prevailing narrative right now is that generative AI will fundamentally disrupt the traditional software as a service model.
Because anyone can just code it themselves now.
Exactly. Investors are terrified that clients will simply use AI to build their own internal tools rather than paying massive, recurring subscription fees to external software vendors.
Wow.
So even when a company like Palantir proves that narrative wrong with actual phenomenal revenue, the market is so consumed by the fear of future AI disruption that they punish the stock anyway.
It's all about the fear of what's next.
Right. And frankly, it doesn't help that Palantir is trading at a multiple of 100 times its future earnings. When you are priced for perfection, any narrative fear causes a massive sell-off.
So, public investors are terrified of software, but our sources point out that this software panic is actually creating a very quiet, very dangerous time bomb in the private equity space.
Yes, this is a critical piece of the puzzle. Private equity firms like Apollo and KKR have massive exposure here.
Right.
Now, Apollo made a very smart move recently by shifting to daily pricing for its fixed income assets, trying to provide, transparency to a traditionally opaque market.
But that doesn't solve the underlying structural issue, does it?
Not at all.
Walk me through the mechanics of that issue. Like, why is a public drop in Shopify or Palantir a threat to a private equity firm?
Well, because private equity firms buy companies using massive amounts of debt. Let's say a PE firm bought a private software company 2 years ago.
Okay.
They valued it based on what similar public companies like Shopify or Palantir were trading for at the time.
Ah, I see where this is going.
Right. So if those public equivalents have now seen their valuations slashed by up to 50% due to this AI panic, it implies the private software companies are also worth half of what the PE firm paid for them.
And because they use debt to buy them, the bank eventually comes knocking.
Precisely. When those loans come due, or if the debt needs to be refinanced, the math just no longer works. The collateral has basically evaporated.
So what happens to the PE firms?
These PE firms are going to face massive collateral calls. It's going to force them to either inject huge amounts of their own cash or simply walk away and default on those companies entirely.
That is a wild dynamic. The exact same AI that is making chip makers rich could trigger a massive debt crisis in private equity.
It's a double-edged sword.
But I want to step completely outside the tech bubble for a moment because the rest of the market is dealing with this barrage of chaotic wildcards.
Yeah, real-world problems.
And what the sources show is that this high-pressure environment is brutally exposing who the good corporate managers are and who is just making excuses.
It really is a crucible right now. You cannot hide behind macro trends anymore.
Let's look at the geopolitical wildcard. We have severe tensions in Iran, with critical infrastructure being attacked in the Strait of Hormuz. Initially, oil prices surged.
Which is the standard reaction, yeah.
Right. And just as a purely factual market input here, former President Trump stepped into the narrative, claiming the war is over while simultaneously threatening to resume bombing if a peace deal isn't reached by Thursday.
And strictly from a market perspective, commodity traders and algorithms process all of that simply as data points regarding supply risk.
Just noise in the machine.
Exactly. The ultimate result of that diplomatic whiplash was oil prices actually settling back down, with Brent crude declining below $100 a barrel.
But the mere existence of that volatility was enough for some companies to use it as a shield.
Oh, absolutely.
Take Whirlpool. They had an absolute disaster of a quarter. They posted a 56-cent loss. They slashed their forward guidance in half from $6 down to $3, and they blamed the war.
Right.
But then you contrast that with McDonald's. McDonald's navigated the exact same tough global consumer environment, the exact same geopolitical fears, and still posted a 3.8% growth in same-store sales.
It's a stark contrast.
I mean, I have to ask, is the geopolitical situation in the Strait of Hormuz really stopping someone in Ohio from buying a washing machine, or is this just the corporate equivalent of the dog ate my homework?
If we connect this to the bigger picture, it is absolutely the latter.
Yeah.
We are in a hyper-efficient market dominated by those massive tech margins we talked about.
Right.
When you are a legacy company with poor management, whether you are Whirlpool blaming geopolitics for bad appliance sales, or a legacy payment company like Fiserv dropping 15% because newer financial tech is just eating your market share, you are being brutally exposed.
There's nowhere to hide.
The market simply has zero patience for inefficiency right now.
And that brutal punishment of inefficiency isn't just happening in retail or appliances. We're seeing it in the mergers and acquisitions space, too.
Oh, the GameStop situation.
Yeah. GameStop, the original meme stock, made this bizarre bid to buy eBay for $60 billion.
Which is structurally absurd when you look at the mechanics.
It makes no sense.
eBay is 4 times the size of GameStop.
Exactly. The amount of debt GameStop would have to take on to absorb a company 4 times its size is astronomical. It was so mathematically flawed that Michael Burry, the famous investor who had actually touting GameStop previously, liquidated his entire position the moment he saw the debt levels they were planning to take on.
He just walked away.
Yeah. When a company tries to force growth without the underlying math to support it, the market instantly rejects it.
It really highlights the danger of meme stock valuations trying to operate in the real-world M&A space. You can trade on internet hype all day long, but you cannot buy a $60 billion company with it.
No, you cannot.
The math just breaks down.
But while GameStop is flailing, You have real, ruthless corporate warfare happening in logistics. Amazon is aggressively entering FedEx and UPS territory.
This is a huge shift.
They aren't just shipping their own packages anymore. They're opening up their massive freight network to non-Amazon sellers. And the mechanism here is fascinating. They are basically commoditizing shipping.
Which is terrifying for the legacy carriers.
The market reaction was instantaneous. FedEx dropped 8%, UPS dropped 9%.
Because Amazon is leveraging its insurmountable infrastructure. They have spent decades building a logistics network that no one can replicate, and now they are using it to just crush legacy competitors.
It's ruthless.
But if you want to talk about raw, unchecked power, the most glaring wild card in our sources is FICO.
This one is staggering. FICO, the credit scoring company that basically dictates whether you get a mortgage or a car loan, has hiked its prices by an astonishing 1,500% over the last 5 years.
It's hard to even wrap your head around that number.
It has sparked an all-out war with the credit bureaus. How does a company raise prices by 1,500% without losing all its customers?
Because they have a monopoly on the standard.
Okay.
Every bank, every lender relies on the FICO score.
It's just baked in.
Exactly. It is baked into the foundation of the financial system. They can arbitrarily raise prices by 1,500% simply because they know their clients have absolutely no alternative.
And that ties everything together perfectly, really. Whether it is Amazon crushing logistics competitors with sheer scale or FICO hiking prices just because they can, we are looking at a market where dominance is rewarded disproportionately.
That is the defining theme right now.
So let's synthesize all this data for you, the listener. If you are trying to make sense of your portfolio or the nightly news, what is the ultimate takeaway here?
Well, the first core takeaway is acknowledging the valuation reality. By any traditional metric, the market is historically expensive.
Right.
If you look at the Shiller PE ratio, which essentially measures a stock's current price against 10 years of its earnings to sort of smooth out the noise, it is currently sitting over 40.4.
Wow.
For context, the historical average is just 17.8. Furthermore, the market cap to GDP ratio is at 228%.
So those numbers usually scream that we are in a massive bubble.
They do, yeah, if you were looking at a traditional industrial era economy. But this expensiveness is a mathematical reality of a fundamentally altered market.
Because of tech.
Exactly. Remember those margins we talked about earlier?
Yeah.
Tech companies, with their massive growth multiples and 20% operating margins, now make up 50% of the pie. The market is expensive because the companies driving it are highly profitable tech monopolies.
And that is the crucial value here for you. You have to mentally separate the broader physical economy from the S&P 500.
They are not the same thing anymore.
Not at all. The broader economy is flat. People are struggling to buy houses, and companies like Whirlpool are floundering. But the S&P 500 is not the broader economy anymore. It is an AI and tech-driven beast.
Making sense of this data is really about understanding those structural shifts beneath the daily noise.
Which brings us back to that tornado outside your window. The disconnect between the data on your screen and the chaos in the world isn't a glitch. It is the new feature of the system.
It's the new normal.
It is.
Yeah.
But it leaves us with one lingering, slightly terrifying thought for you to ponder. If half of the S&P 500 is entirely dependent on just a handful of tech giants, and companies like FICO can arbitrarily raise prices by 1,500% without losing a single ounce of their market position, we have to ask ourselves, are we still investing in a dynamic, competitive free market, or have we simply transitioned into an era governed by untouchable corporate monopolies?
It really forces a total reevaluation of what free enterprise even means today.
Something for you to chew on until next time. And hey, before we sign off, a quick note for you. To access more advanced researches, applications, and our latest published personal intelligent multi-agent deep value intelligence, welcome to explore and join the deepvalues.ai community.
And if you want to track total market temperature yourself, welcome to search and download the iOS app Buffett Indicator from the Apple App Store.
Absolutely. Finally, a quick disclaimer. All analysis today is based on publicly available sources and may be subject to revisions or differing interpretations. All contents from this channel is for educational and research purposes only and does not constitute investment advice. Conduct your own due diligence before making investment decisions.
Leslie, do your homework.
And if you'd like to access wider topics, including life and investing philosophy, please subscribe to our sister channel, Deep Values. Don't forget to like this video. Much appreciated. Stay curious, keep looking past the headlines, and we will see you next time.